Welcome to Ask the Compound, the show where you ask and we answer. I am Ben Carlson. Let's say you have a friend who's a YOLO trader. It's not just speculation this person is into. They're concentrating into a YOLO trade on one stock using leverage. How do you talk them off the ledge? What would you tell them? How do you help them make their money back after they've lost it? We're going to help YOLO traders and more on today's show. Please stick around. Our email here is askthecompoundshow@gmail.com. If you're watching live on YouTube or on Twitter, please send us a question. We'll take it live on the air. As always, on today's show, we will be answering questions straight from our compound viewers and listeners on fixing your friends who are terrible investors, selling tech stock winners into retirement, when a Roth 401k makes the most sense from our trusted tech expert, how to pay for home renovation, how to pay no taxes in retirement, people love that one, and how much is too much in an HSA. Today's Ask the Compound is sponsored by Exhibit A. Exhibit A was started by our own chart kid, Matt, who came to us and said, I got this idea. Advisors love good charts, but they don't have time to make them. They don't know how to make them. I'm going to help make the charts. I'm going to provide the talking points. The advisor just signs in. They put their firm logo, their firm colors. It works great. So if you go to exhibitaforadvice.com, you can sign up there. Look at all these great charts you can do. Again, your logo, your color scheme. It's beautiful. He has chart blasts every week. They have explainers. They have talking points. You send these out to your clients, help them explain the markets, put things into context. And again, you can sign up at exhibitaforadvice.com. Free 7-day trial. If you're an advisor, you need this. Your clients will love it. It'll make your life easier. exhibitaforadvice.com.
It's kind of like we're sharing Chart Kid Matt with the world, you know?
Really?
You get your own... Yeah, you get
people love his charts. I got a message from some guy the other day on LinkedIn. I don't ever check LinkedIn messages. Started the people who messaged me there. I checked them for the first time, and this guy said, "Hey, how do I get your charts?" I said, "Exhibit A. It's easy."
There you go.
All right, Ben, lots of questions today.
Ben, before we jump into that, are you excited about NVIDIA earnings?
I don't care.
All right.
No.
It's not a make or break moment for the market.
I own NVIDIA. I actually own it. This is like one of the few stocks I own. But yeah, we'll see.
All right. I was just trying to get you to say a bite we could use on social media or something.
Yes, no, this is the most important earnings call in history of earnings calls. If NVIDIA fails, the stock market is going to go down. If they do well, it might go up. I don't know. Okay. Or it might not. All right.
There we go. Love it. All right. Up first, we got a question from a mix of names here, so I'm not going to say a name. Maybe it's supposed to be anonymous.
This might be an anonymous one because of the information.
Yeah, I see multiple names, so I'm just not going to say one. Okay, let's say I have a brother. Let's say he was on a lucky hot streak this year, YOLOing into the most speculative plays in the market, quantum, crypto, meme stocks, etc., and was up 100% year to date. Pressing his luck, he thought it was a good idea to put nearly all of his portfolio into MSTR. That's MicroStrategy, or now just Strategy, right?
Yep. The Michael Saylor Bitcoin vehicle.
Okay. So he put nearly all of his portfolio into MicroStrategy using margin when it was trading the 300s. He's now down 50%. I told him not to touch MicroStrategy with a 10-foot pole, and if he was bullish Bitcoin, to just buy Bitcoin. I also told him to never use margin, especially on high-risk stocks. He is at risk of losing half of his net worth and has a home purchase on the horizon that's in jeopardy. Now he suddenly wants my advice on how to get out of this mess. I told him that I don't know, and I honestly don't. How do you deal with people that consistently ignore your advice and then want your help to get out of a mess? I suspect there are many YOLOers out there facing this situation, but too ashamed to admit it.
Is this one of those Fight Club things where we get the Edward Norton, Brad Pitt, and the brother is really the same person?
That's what I thought.
Wink, wink. Listen, I'm sure he's right. There's plenty of people out there in the current environment who have slowly but surely turned up the risk dial from aggressive to degenerate. And the hard part is
50% of net worth is a lot.
Yes. Here's the thing. It's hard. It's hard to see when you've morphed from I'm a really aggressive investor to I'm a degenerate gambler. When you're making money, when things are going up, you don't realize oh no, I'm a degen now. So I think there's people who have taken on excessive level of risk. They've been compensated for it in a lot of this stuff. And now it's turned on some of these stocks. And so, man, listen, putting half of your net worth into Michael Saylor's leveraged Bitcoin play, right? Using your own leverage on money that needs to be used for a house. This is you have a problem. We need to do when they take Cousin Christopher and give him intervention on Sopranos because he sat on the dog after doing drugs. This is intervention level stuff. Okay, so his brother got into the stock in the 300s. Let's do the first chart. It's now sub $200 a share, and I'm not a technical analyst, but this doesn't look like an uptrend to me. This is like a waterfall, or what do you recall it? So next one shows a drawdown profile. This is just this year. The stock is down nearly 60% from the highs that really weren't that long ago. This is a few months ago. I'm sure he was feeling great. Like, this thing's awesome, right? I think it peaked at like $470-something a share. All right, chart off. So this is like a 2008 level crash in a matter of months. So here's the thing. I'm not even going to make a judgment on the stock. I don't know if Michael Saylor's Bitcoin experiment will work or not, right? They're getting a premium. Now the premium's gone away. I think if Bitcoin keeps going up over time, this thing is not going to get crushed, at least, right? So I think it really is tied to Bitcoin. It's like, but can the leverage play last until then, and will investors still keep giving the money? I don't know. It's already worked better than anyone expected, right? But this stock has got huge gains followed by huge losses. So let's zoom out a little bit. Go to the past 10 years of drawdowns. So here's what I spy on this chart. You're looking at a 20% drawdown to start. Then we got a 50% drawdown. These are all separate drawdowns. A 90% drawdown after the 2022 bear market, which is insane. And then a 46% drawdown, and now a 60% drawdown. And the crazy thing is, despite all that volatility, chart off please, the stock is up more than 900% in total in that time, in the last 10 years, despite all those different bone-crushing crashes.
Not bad.
The problem is the brother did not take part in the 900%. He bought near the top, maybe held on for 25%, 30% gains, and he bought on margin. Holy cow. And he's going to be buying a house.
Keep in mind,
soon.
a lot of people are watching this show and are completely new to finance. So when people say margin or leverage, they mean they borrowed money to invest.
He's
correct?
borrowing money, yes.
And so they're
which
paying
amplifies
interest
gains,
on that too.
amplifies losses. This is a Dumb and Dumber moment for me. Do you realize what you've done? But there's not a bus full of beautiful women waiting at the end of this one. Here's the thing. You could try to offer this kind of person advice. Sell now before it gets worse and you get a margin call. You don't want to do a margin call and throw good money after bad. Invest in something far more reasonable and diversified. When I first started my blog, A Wealth of Common Sense, I had this dream. And my dream was that I'm going to somehow save people from making illogical financial decisions. That's the whole premise of common sense, right? Just use your common sense. Don't be an idiot. And after creating financial content for more than a decade now, I've come to realize that some people cannot be saved. And it sounds like a mean thing to say. Some people are just doomed to make money mistake after money mistake. There's nothing you can do about it. You know how you have those friends that you grew up with and you go, man, this person is kind of delusional, but they're going to figure it out eventually. And then you hit middle age and you go, oh, this person's never going to figure it out, right? We all have those people in our lives. Like, oh, this person's just always going to be going from crisis to crisis, bad decision to bad decision. And some people need to make a big mistake like this to have the realization, like this aha moment, like, oh gosh, what was I doing? What was I thinking? Just to change their behavior. That does happen. I know an advisor who runs a solo practice who constantly turns people away that he knows will be bad clients. And he tells them, like, nope, you're not ready for me yet. Go make some more mistakes, then come back and talk to me. And he says some people come back, most people don't. So can the brother here be saved? Maybe. I think he might need someone to take the steering wheel. Like, it's one thing if you're YOLOing as a young person without a lot of responsibilities, right? You don't have a lot of money. You're gambling, speculating, hoping to strike it rich on a lotto ticket. I don't recommend that. That's okay though, at a young person. But when you are talking about money that's meant for a house, which is a short-term thing, and you're putting margin on top of margin on top of margin on top of Michael Saylor, you have a problem. This is like, I don't know what to do. So either you put your portfolio on autopilot, or you hand the keys to an advisor or a family member, or otherwise you're not gonna learn your lesson until you get margin called to death, and then you're broke. That's the only thing here.
Well,
I don't think there's.
The hard thing is he can't go the opposite direction either, though, right? Like, he can't just go into treasuries. He's not gonna, like, he has no chance of even recovering.
Well, but
some of
here's
his
the thing, though.
losses,
You
right?
don't want a revenge trade, though, because obviously you lose
Right,
50%, you have to gain 100% to get just to break even. Everyone knows the math there, right? But you don't want a revenge trade and go like, once I break even, then I'll chill out. Like, maybe you have to take your time to break even. And because he was it sounds like he was sitting on big gains anyway, right?
The answer is not triple levered S&P either.
No, just something more reasonable. Listen, is this guy going to go in a target date fund? Probably not. Should he? Probably. Keep us posted. But I'm afraid this is going to end in tears.
Yeah, I mean, So a lot of tax loss harvesting. Is that the silver lining?
I
Half
hope
of your
so.
net worth.
All right. I hope I hope his house doesn't fall through. But yeah, maybe if buying a house, the treasuries are the answer for right now. T-bills.
Yeah.
All right.
Yeah,
See another question.
I feel bad for them because I know that it's very easy, personally speaking, to get caught up in this. And there might have been a time when, not that long ago, I was just buying whatever stock was going up the most on the day and then selling it after it went up 10%. And so I've been known to fall into some of these things, but yeah, the leverage part is I think the most dangerous
the
part
concentration
of this, right?
too. If you want to speculate, like position size it correctly. Take 10% of your portfolio and speculate your face off. I don't care, but 50% of your net worth.
Yeah.
That is, and on margin, that means guess what? You're doing more than that. It's yeah. Someone in the chat says if the margin calls, just don't answer. Then they break your kneecaps.
Also, why is it's so often people that are into Bitcoin that end up, I guess it's just a risk appetite thing, like people who are really into crypto.
I think people in that, if you've been in that asset long enough, you are more comfortable with volatility.
Yeah, you've seen crazy gains.
So yeah,
and
there's
crazy drawback.
10, 20 time leverage in some of these people. And that's why you see people get wiped out when Bitcoin falls 10% or something. So why would that wipe someone out?
Yeah.
All right, next question.
Hey, yeah, good luck. Good luck to your brother, though. I mean, I hope they figure it out. Like, there's a part of this, I'm laughing because like some of it is funny, like, yeah, putting all your money into something so speculative, of course, it's kind of comical, but like in reality, I hope they're gonna be okay because that's a lot of money to lose.
Yes, but he's right. There's probably a lot of people who are in a similar boat who've gotten way over their skis, and then a stock falls 50 or 60%, and you go, oh my gosh.
Oh, for sure. Yeah.
What do I do? I didn't expect this.
Yeah.
No one does, obviously.
Yeah. All right. Up next, we've got another anonymous one. Wow, we got a lot of cagey questions today. Okay. You have to answer my question because I'm a female listener. I love that this is a thing now that we started.
This is extortion. No, we said it. We have to follow through.
We said there's so few women in finance and listening to finance podcasts. So here you got us. You have to answer my question because I'm a female listener. I've also unleashed Bill by saying his name 3 times. I've spent the last 15 years in big tech sales. I'm 55, have about $1 million in 2 big tech stocks with a low cost basis. I never really sold the vested stock, and now over the last few years, it's a significant amount of my net worth. I'm still working and at the highest tax bracket, so I've been reluctant to sell. While I am partnered, we keep our money separate. My husband is retired, and I would like to retire in the next 2 years. Part 2. How should I think about asset drawdown and taxes? Assuming I have no income except for what my portfolio casts off, which is less than $48,000 a year, could my capital tax rate be 0? If I want to get out of this heavily leveraged tech position, do I sell most of the tech stock in year 1 of my retirement? I'm worried-ish about a bubble too. I have about $800,000 to $1 million of cash that needs to be reinvested. Since I have a margin of safety, should I write it out a few more years and slowly sell?
All right, Beetlejuice rules apply here. Time to bring out Bill Sweet.
Yeah, I ran so fast to answer the call, my beard fell off.
Oh my God.
Yeah, on the way upstairs. So here we go.
Nice.
Looking good, Bill. Okay.
Thank you.
So we've got, it's funny how taxes have seemingly kept a lot of people in these stocks over the years. It's like, hey, if it keeps going up, I know I probably should sell, but I don't want to because I got to pay taxes. So we get a million. We've gotten a million of these questions. Again, bull market questions, but still, this one is a little twist on it because it's asking about retirement, right? How does it differ in retirement if maybe my income falls to nothing and it's just portfolio income? So what say you? Is there any easy way? Because people want to know, like, I want to hit the easy button on this. I want to get out of this. I want to keep my tax bill minimal. And I want to spend the money. What do I do?
Yeah, love this question from an anonymous listener. Thank you very much. But to me, Ben, moving from an accumulation portfolio, which is where we've been, to a distribution portfolio, which is what it sounds like, that is not an event. It's more of a process. So Ben, my argument would be there is no easy button. This is the work of an advisor, a CFP type advisor in conjunction with a responsible tax team. There are a couple of levers though that you can hit. And what I love about where the listener is, there were some additional details we received. There is a large Roth balance. So that was one thing that I was very, very excited to hear. But for the purpose purposes of capital gains, the listener hits on something really interesting. If there is no other income outside of some dividends, $48,000 a year, for a married filing joint couple, you can take up to $130,000 of total income from capital gains and other sources, and basically pay 0% on that transition.
Oh, wait. She said they're partnered, but keep things separately. What if they file separately?
No, that's a great thing. So I specifically mentioned jointly, right? So we would need to analyze, hey, are we filing jointly or not? But even if we're filing single, Ben, then ultimately you're still eligible for half of that, which limits, I think, if we're talking about this is one individual's assets, right? Filing a separate return. So big picture, it's complicated, but ultimately I like where this is going. And it may not be a fact of, hey, we want to, because Ben, you correctly identify capital gains as an obstacle, right, to a diversified portfolio. If you've been successful investing, taxes are the fruit of that labor. Like, you're going to have to trim that tree eventually. And the question is, do you want to do that after a long bull run in the kind of market that we've been in now? I would argue, yeah, this is a great time to look at that, versus do you wait for a 20 or 30% drawdown? And then the nice thing about a drawdown like that, Ben, is if you don't have your gains, you don't have to pay tax on that, right? So give me the taxes. I would argue in that direction. I would fill up low tax brackets, because I think that's the gist here. And that, like I said, Ben, is the work of a competent planner over a 5 or 10 year period.
Right. So ripping the Band-Aid off just means that's the trade-off between hoping the stock doesn't fall and then paying the taxes right away.
Yeah. I think that's it. Taxes, like I said, some people hate paying taxes more than they like making money. I would take the opposite tack here. And I think, Ben, a great time to do that would probably be rolling over the calendar, right? January 1 or so. You realize your gains early in the year, and then you can effectively deploy, let's say, a tax loss harvesting strategy, some other options that you might have to realize losses to kind of whittle down on that gain as the year progresses. I think that's an excellent way to rebalance over time.
And we've talked to other clients too who have, if they have a huge position, there's other options. There's other strategies you can use, like options, to sort of hedge against the stock falling, right? There's a cost to those options, but there are ways you can do that without completely selling the stock, as you slowly but surely get out of it and use tax loss harvesting and all those other things. So there are strategies you can employ, but you're right. It's not something that you take lightly. You need someone to help you with those.
Yeah, and I would go that route, Ben, if there was a very concentration, let's say like half of the portfolio was in a single company. That didn't sound like this situation. This seemed more diversified, maybe concentrated in tech. But Ben, a couple of things that we've been looking at recently, just to throw them rapid fire, we've been looking at options like Section 351 exchange. That's something that you've seen a lot of platforms and products coming to market. That might be something to sit down and take a look at. We've been looking at exchange funds as an option. There's a 7-year holding period, right? So it comes with trade-offs, but you do get a lot of instant diversification there. Or looking at plain old tax loss harvesting, and that using the other assets in your portfolio, build those around those concentrated positions and begin to whittle those down over time.
So someone in the chat says that she should just marry the MicroStrategy guy. He's going to have the losses. She's got the gains. That could be a dating show on CNBC. We pair people based on their opposites attract, right? We take one person, huge gains, one person, huge losses. Bill, let's say they got married this year, before the end of the year. Could they offset each other's gains by filing jointly, or does it not work like that?
Well, this listener seems like she's spoken for, and I can say her investing acumen is top notch. But in the event that we wanted to roll out a show, the answer is, for other listeners, yes, Ben, you could effectively take very successful female investors and match them with degenerate gamblers.
I'm making an app.
Side.
That's it. I'm making a swipe thing.
Sounds like a great deal for the responsible
swipe right
person.
for losses, swipe left for gains.
In heaven. Yeah. So but to take it seriously, 12/31 is the date that sets your status, right? So if you happen to be married on 12/31, whether you got married that day or the day before, that's the date that you can claim.
Think about it. This is a dating app where the losers finally win. Like, all these people have huge gains in their tech portfolios. If you're a loser who's got the big losses, everyone's going to be lining up to get paired with you.
Yeah, there are other reasons to maybe consider entering holy matrimony, but tax losses are definitely something.
It does sound like this instance, she has a lot of flexibility too with her other assets. Like you said, she provided us, she has some Roth assets. She's sitting on a bunch of cash.
Yep.
So if there is a tax bill, she's going to be okay.
Yes. So I think the trick for me would be have a plan, obviously, but then yes, those other accounts that you mentioned, Ben, are more flexible. They're more, you can do different things to build around those positions, and then sit down with a qualified planner and figure out, okay, how do I prioritize these
And
exits?
It doesn't sound like she is really like beholden to just these two stocks. Like, she has another whole portfolio. she can tap. So it's not like these two stocks are nothing, right? That's because that makes it even scarier.
Yeah, and furthermore, Ben, I think everybody's got this bubble fever right now, and I understand the thought process here, but we won't know, right? What's going to happen until it happens. And the truth, the reality is, these companies are highly valued for a reason, right? And I love, Ben, the point that you've made, and Josh has made this point, and Michael has made this point, that like we're getting better at investing and running companies. Like CEOs, CFOs, COOs are better today than they have ever been. And they're better at managing a balance sheet, and that to me gives me a lot of some solace when it comes to margin compression.
Right.
Sounds pretty toppy to me, Bill.
Yeah.
Just worried-ish, not worried, worried-ish.
Famous top tick words. But hey, if the market drops, great opportunity for a Roth conversion.
Speaking of which, let's do another one.
And great job, and thank you for the question. Also, Christopher Flint in the chat says, "I feel so poor reading these emails." Yeah, we get that a lot, but you know, larger stakes makes for more interesting questions, and these are most of the questions that we get.
We have a service model for every client too. Yeah,
we do. But the thing is too, like with a lot of this advice, take a zero off here or there. Like I used to say when I worked in the institutional world, just for institutions, I'd say it's just a couple extra zeros. Like the building blocks are still the same, right? And so it's the same thing if you've got $1 million tech portfolio or $10,000 tech portfolio. Right? Just think through things the same way. It's just a little more or less money.
That's exactly it.
All right. Let's do another one.
Okay. Up next, we got a question from Eric. My employer is adding a Roth 401k option starting in 2026. Right now, I only contributed enough to my traditional 401k to get the full employer match. My plan is to keep contributing up to the match in the traditional 401k, about $3,000 a year, and then put the rest of my contributions toward the Roth 401k to max it out. My net worth is about $1.5 million. I have $550,000 in pre-tax retirement accounts, traditional 401k and traditional IRA, and about $80,000 in a Roth IRA. I ultimately want to roll Roth 401k contributions into my Roth IRA as I believe it's a bit light. Does this strategy make sense? Any issues I should consider?
All right. So first of all, good on the company for issuing the Roth 401k. I don't know what percentage. Bill, do you have an idea? Like how many actually do it? It can't be that much.
I want to say it's somewhere in 15 to 20% today, Ben.
Okay. Luckily, Ritholtz Wealth Management does this, which I'm sure you're happy with. I am too. And you forcefully made me do this.
I'm a company man.
Put the gun to my back and said, no, you're doing a Roth 401k. So I think it seems to me that his Roth IRA is a bit light, and going for the Roth 401k option makes a ton of sense. I can't imagine you would disagree here.
Yeah, Eric, I want to welcome you to the dark side. I went with IRA Roth Max as my screen name here for a purpose. Ben, it might not surprise you. I fully endorse Eric's plan. Let's think about this for a second. Let's live in a world where Eric does not pursue this strategy. So he's not putting an additional $21,000 a year or so, right, in addition to his matching contribution traditional. That money's going to hit his checking account, correct? Mm-hmm. Right? So if he puts it into the retirement plan, he's probably going to invest it and be successful. But if it's going into a non-qualified account, he's going to pay interest on the dividends, taxes on the dividends, and taxes on the interest. And then if and when he liquidates that asset 10, 20 years from now, he has to pay a capital gain. So Daniel, can we chart on? I did a quick analysis, and this is not advice. You need to consult with your tax professional. But the difference here, if you focus on the right side of this chart, it is about a 30% gap between what you would realize if you rolled 20 years of $21,000 contributions into a Roth IRA from a Roth 401k. You would roughly have $1 million balance completely tax-free, assuming you're taking qualified distributions after age 60, versus roughly $715,000 on an after-tax basis if it was a non-qualified account. So Ben, I ask you, is 30% tax savings, is this worth it for Eric?
It's pretty good to me.
Yeah.
Right.
And that's it. And again, back to Roth, this mega super 401k, this is a huge opportunity to get funds into this space. And then we're going to answer a question later on what you do on the back end that even ripens this. So when I proselytize Roth, it's exactly for people like Eric.
All right. And I got to do a PSA here since we're talking about retirement plans. So throw up my chart here. I looked at this. This is the annual 401k contribution limit going back to 2000. And Bill, I always complain to you, why don't they index things to inflation like the losses that you can use on your taxes? Mm-hmm. But with retirement contributions, they actually are doing a very good job. Yeah. And this century has more than doubled. And so now for 2026, we're talking $24,500. I think if you're 50 or older, what do you get? $8,000 extra?
Yeah, it's an additional 7,750. Yep.
And if you're like 60 to 63, you get an extra $2,000
Correct.
bucks or something.
Yeah, that jumps up all the way to 12,750.
Yeah, so chart off here. So like this is a great thing. And then if you do it with a Roth 401k, right? Yes, you're paying the taxes up front, but you can actually, the way I look at it as you're able to put more in because it's a Roth 401k.
Yep.
I know it's not really that way but no one ever invests the difference.
Yeah.
Right? So you can put 24,500 in the Roth or the traditional, right? But that Roth is after tax money. So I think to me, in my brain, it means I'm putting more money in because it's a Roth 401k.
Yep. And then you can even do, Ben, these really crazy plans have these ability to fund all the way up to the 414 limit, which is last year was 70,000. I want to say it's 72,000, 72,000.
Yeah, so that's like a SEP IRA,
Correct.
$72,000.
Yeah, you can do it that way. But again, what you can do is contribute dollars on an after-tax basis. And then if you can convert those after-tax dollars to Roth, you effectively can supercharge that up to like I said, in excess of $70,000 a year. Per year. So that's a great way to do it.
Dave in the chat said that IRAs have not kept up. Throw my next chart on here. I got IRAs on here too. They have not kept up, but they have kept up this century, Dave. So not since the 70s, but look at the increases this century. They've gone from $2,000 in the early 2000s to $7,500 now. And you can see there's a lot more plateaus in the IRAs for some reason. I don't know why that is, but they have increased it a decent amount this decade. And so we're doing better. We're getting there.
Yeah, it's great. It's great.
Right.
But I think,
Good
Ben,
news.
you and I are on team TSB, opening that up to the masses. And frankly, like, I don't understand why your $70,000 contribution limit for this year, last year, should be tied to your employer, right? Why not open that up to everybody?
Yes, exactly. All right. Got another one.
Okay, up next we got a question from Travis. I'm 47 and we have $45,000 left on our 2.875% mortgage. We would like to tap some of our $500,000 of home equity to complete substantial home improvements, kitchen remodel, basement remodel, and lots of landscaping. I'm thinking we'll need around $250,000 to do everything we want to do. I hear a lot on your show about HELOCs, which is a home equity line of credit. And of course, your stance is to never touch a low interest mortgage. Here's my question.
Someone's paying attention.
Yeah. Here's my question. Instead of a 7.25% HELOC or a 7.5% HE home equity loan,
Yep.
what about a cash out refinance? I would be exchanging a 2.875% rate for a 5% rate for a refi. Is it a no-brainer to do a cash out refi, maybe when my 2.875% loan is almost gone, like less than $10,000 left, instead of a HELOC in that situation?
You know,
They
I
lost me
noticed
out
that
on this math, so this is on you guys.
we got it. So people who have a low-rated mortgage will happily bring out to 3 decimal points. Instead of saying 2.9%, he had to say 2.875, right?
Yeah.
The one a few weeks ago was 2.625. That's
Yep.
when you've got to use all the decimals.
That's
That's a total not to brag. Like, hey, I got 2.875. I'm way lower than 3. Okay, so here's the thing. Great. Congratulations on the renovation. That's a lot of money. I guess it makes sense. These things are not cheap, but
Are they building a golf course in Marietta?
If this is your forever home, landscaping is
I'm
expensive.
guessing
Kitchens are
bathroom,
expensive. This actually does not surprise me that it's that much.
Yeah.
And listen, if they have this low rate and it's almost paid off and they want to stay in this, make it a forever home, I get it. I understand why people are doing this. So here's the thing. HELOCs are floating rate. So that's one thing to consider. So taking out a HELOC, yes, it's like 7.5 now. I looked at mine this morning. Mine is 6.75. And it was way more than 8% at the heights of. So if the Fed keeps cutting, I would imagine that these things will fall. So that's one thing to consider. The HELOC could fall, whereas if you do a cash out refinance, then you're locking it in. But you said it's like a 5% rate right now, so that's not terrible actually. So I don't really mind that. Plus, with that one, you're locking it in, right? You're locking in the rate, you're locking in the payment. With HELOC, it could fluctuate. If inflation comes back and rates go back up, then your HELOC payment could go up. Mm-hmm. The one thing I do like about the HELOC is it offers you a lot more flexibility, because usually the way it works is you have 10 years of interest only, you have no principal payments, and then from that point on, then you have 15 years to pay off the principal, right? So it gives you a little more flexibility on when to pay and how much to pay. Anything I'm not thinking of here, Bill, that they could do? Obviously, we haven't talked about like a borrowing against a stock portfolio or something, but is there anything else that you would consider here in terms of like getting this done?
Yeah, no, Ben, I think you hit it all. Travis, this is a time value of money question. I think, Ben, a cash out refinance is a great option. It allows you to lever the asset, right? A lot of equity is tied to that house, right? Your loan to equity value is like 10%, which is fantastic. And ultimately, you could have a couple of options. You could just take out a brand new loan, right, and roll your existing balance into the new one. I did some quick back of the envelope math for a 15-year loan. We're looking at about $2,300 a month. So that's going to be about $414,000 over the life of the loan, which would start at roughly $295. Because keep in mind, we have that existing balance. Or we could go all the way up to $1,600 a month for a 30-year payment, right? And that would increase the total.
Hey, you're effectively taking out a new mortgage. And the thing is, that's the whole point of the house is that, like, if you're putting this much money in, hopefully you're increasing the value of the home as well. You're adding equities. It might not be a one-for-one deal, but you're hopefully adding some value.
Usually isn't, but I think there would be some reasonable expectation as you share a house, you'll get it back on the back end. But I think, Ben, you correctly identified it. If we're planning on staying in this house forever, like, I probably would sit down and consider the 30-year option, just based on your cash flow needs. Because ultimately, I'm guessing the mortgage, just where you are, like, you probably don't have a large mortgage payment. So if a $1,600 a month mortgage is kind of shocking, like, I don't know that I would go all the way out. There.
And then you can, if rates go back to 3% for some reason, if we get a nasty recession, you can refinance.
Yeah, and you could even start out with the HELOC, right, to get everything paid and financed, and then ultimately talk to the bank afterwards. So yeah, you've got a lot of flexibility here. I don't think any of these options are bad. There's just trade-offs.
Yeah, I think you're thinking about it the right way. I think they're approaching this in the right manner.
Correct. Yeah, but I don't see any reason, Ben, not to lever the house. I mean, that sometimes people, like you said, borrow from a stock portfolio, something else. You are introducing a little bit of risk there, and particularly, like I said, with a 10% loan to value, why not? Why not use the equity that you already have?
Yes, exactly. That's what it's there for. What else is it going to do for you if you're going to stay in the house?
Yep, exactly.
So I got something from the chat going back to the previous question. They say, I still don't understand the benefits of a 401k. Qualified dividends are already taxed at a beneficial rate. Why roll that into a 401k when it counts as ordinary income when it comes time to withdraw?
A traditional IRA, Duncan, we were talking about Roth IRAs.
Okay.
Do you gentlemen know what's the distribution tax on a qualified Roth distribution? It is zero.
Nothing.
Zero.
So I understand the qualified dividend rate is 15%, but you know what beats that? Zero. Zero beats 15 just about every time.
All right, we got more Roth stuff in the next one.
Of course.
And a local Michigan question, too.
Yeah, I love the curveball.
This next question is called Cracking the Roth Code. I've always wanted to submit a not to brag question and a Bill Sweet question, so I'll check both boxes with one. I'm a 50-year-old surgeon married to a 45-year-old surgeon living on the shores of Lake Michigan. Combined, we have 2.5...
This guy won the game of life.
Yeah,
Look at that.
Sounds like it. Combined, we have $2.5 million in tax-deferred accounts, $1.5 million in a traditional taxable account, $600,000 in 529s for our young boys, and surprising even to me, we have over $600,000 in Roth accounts. We should have well over $1 million in Roth accounts by the time we retire. Here's the plan I've been contemplating, and I would love to hear Bill tell me where I'm wrong. If we supported all our initial retirement spending from our Roth account with appropriate dividend planning, we would have almost no taxable income. This would allow us an enormous buffer, $96,000 in today's dollars, for Roth conversions from our 401ks with essentially no tax implications. We would then simply rinse and repeat every year, partially refilling the Roth bucket until we have to take mandatory distributions from our 401ks or start Social Security at age 70. Have I cracked some kind of code, or am I completely wrong?
People love to figure out how to not pay any taxes in retirement, obviously.
I'm picturing Always Sunny, Charlie, like with the math, like this. That's what I'm picturing here.
So, Bill, you're a big Roth guy, but does it make sense for these to do these conversions in retirement? Is that just is that too much?
Ben, and the questioner is Ben too. So, Benjamin, I don't like this idea. I love this idea. This is brilliant. This is winning the game. As we said before, gentlemen, the tax rate on assets that are, let's say your first $130,000 for a married filing joint this year, that's taxed on ordinary income rates at 12%, right? So we're not talking about capital gains. It won't be zero, but 12%, the effective tax rate up to around that amount is about 8 or 9%. It's actually very, very low. It's less than double digits. Furthermore, one of the things that Benjamin didn't do was analysis. He mentioned $96,000. That doesn't include a standard deduction, right? Which this year is jumping up for 2026, even higher. So I love this because ultimately what Benjamin could do with Mrs. Benjamin is sit down at the end of each year and decide, hey, this is only total up all my income, right? I got this amount from bank account, this amount from whatever, and ultimately do that Roth conversion every year and then just spend down from the Roth, right? Because the first thing you get back, even pre-age 60 qualified distributions, is your tax basis, which for Benjamin and Mrs. Benjamin are already $600,000. So effectively what you're doing is you're paying the lowest possible tax rate on a guaranteed amount of conversion every year that you can pre-calculate, you can predetermine, and then you just draw money out of the Roth portfolio to effectively live your life. And you can do that almost up to your basis, completely tax-free at any age. And then once you hit 59 and a half, completely tax-free. I love
So
this idea.
he cracked the code.
This is great. Yeah. In fact, I'd even say, I'm not sure, Ben, shores of Lake Michigan, where are we when you say that? Because Lake Michigan is a relatively large lake. What state are we in?
Dave in the chat asked if it's Wisconsin or Michigan. He's definitely in Michigan. Come on.
Okay, Michigan.
Who we kidding
I was
here?
going to say, yeah, I'll take a look at Wisconsin. But the nice thing about Illinois does not tax retirement distributions at all. Like they have a complete exemption. So if we're talking Lake Michigan, north of Chicago, yes, you could effectively do this completely state tax free. This is a brilliant idea, Benjamin. I've never really sat down to consider this, but I love it.
So I need to retire in Chicago.
We have people there. We have good people there. Yeah,
That's right.
Sounds like it.
All right, we got one more question.
Oh, I wonder if they're like, I'm picturing Todd. That was his name on Scrubs, right? The surgeon.
Oh,
I wonder if they have a lot in common with Todd.
Good pull, Duncan. All right, we got one more.
Last but not least, we got a question from Paul. My wife and I are 38 with kids ages 19 and 7. We've been on high deductible insurance plans for a while and have been paying expenses out of pocket to allow the balance in the HSA to compound. Our income is high enough that paying out of pocket is not a strain on us financially. We have $74,000 in the HSA today. Sorry, I'm just laughing because it is dawning on me what like 1%er show today's show is. Okay, assuming no major medical issues, further contributions.
I'm just trying to make young people really angry today.
Yeah, there you go. Further contributions and compounding seems to say that by the time I'm 65, we could have $1 million in this account. Assuming I stay covered with my employer, my max family out of pocket is $15,000 a year, and eventually Medicare would cover a lot. How would you advise me to balance ensuring adequate funds for the future without overdoing it? How much is too much in an HSA account?
So they're going to make some decent. So they're going from 74,000 a day to $1 million at retirement. I don't know what
it's compound math, Ben. Yeah,
compounding and then making additions. Like, not an HSA guy. Okay, one too many accounts for me. I've mentioned this before. Is there any downside to having too much in this account?
I don't see it, Ben. I think at a minimum, we have a tax shield. Any assets for Paul and spouse would compound there completely outside of taxation. Paul would have the opportunity to take distributions for, let's say, major surgeries. I'm not sure if we have any, family stuff going on, but 2 kids need some braces, maybe. 2 kids, a 7-year-old, maybe, something could happen surgery-wise.
Maybe I could have used an HSA because my son George has broken his braces 7 times. He's had them for a month.
Oh, that hurts. Yeah, so I don't see the
whole
problem
metal
of
thing
building up.
Just falls out.
I don't see the problem with building up a bucket because the worst case scenario is you hit age 65, that HSA effectively becomes a traditional IRA at that age. So I don't see any problem having that amount of assets in an HSA. I think I just treat it as part of my retirement plan. I'd be no rush to take any distributions. It's there if you need it. It's a great compounding device.
Right, and obviously I'm assuming he's filling up the other buckets already too.
Yeah, and Ben, you mentioned in prior episodes, there's this neat thing of HSAs that the year you take a distribution does not have to match the year that you have a qualified expense. So let's say you do sit down with young George and you need a $2,000 distribution for medical bills. You just print that invoice, stick it into a tax folder. You can take that distribution 10 years from now.
Save those receipts, right?
Exactly. And so rule of 7, like $10,000, $5K turns into 10. You effectively had the market pay half of your orthodontist bill in the future. So that to me is a great use of an HSA. I would be in no hurry to wind it down.
And now you're stuck with the HSA your employer provides, right? Because like my wife has an HSA and there's a lot of fees. Like I look at the statements that come and there's a lot of fees. But there's like nothing we can do about that, right?
Yeah, so it all depends on the employer, Duncan. But ultimately what I would recommend for a situation like that is take a look at the fees. Ask if the plan has a rollover option. Can I roll this money out while I'm still working? You have to make the contributions to that plan, particularly if your employer is providing support, but you don't have to remain in that account forever. It's not a death pact. And ultimately, you can set up an HSA roller to a lower cost provider. Major providers have HSA options.
Public and Robinhood don't, though, do they? Now that I think about it, I don't think they have HSA.
I'm not certain. Yeah, the major custodians we work with at Ritholtz do. Okay. But they're both bespoke and plan specific. But yes, Duncan, if you're paying a lot of fees, you there in Connecticut, I would definitely look at a rollover option. Like what if the plan allows it? And I know the CFO over there. Let's make it happen.
So Sean in the chat says his back hurts. What over-the-counter meds do Ben and Bill use? This is not a medical advice show, but I say rub some dirt on it and drink some whiskey. That'll make you feel all better.
Whiskey's a good one. I'm a couple of beers guy. couple of beers will take care of that one. Yeah.
Yeah, that's my only health advice for today.
Yeah, wow, not medical advice. I skipped over that episode.
All right, so we cracked the code for Roth retirement today.
Yeah,
Way to
Benjamin.
Go.
Big ups.
Thanks to Bill, as
also,
always.
Nicole asked me to promote our new Animal Spirits mug, so let me get that right
It is
there in the
lovely.
camera.
idon'tshop.com.
Yeah,
There's a bunch of them in the office. Yeah, we're repping hard.
They're nice.
Holiday party tomorrow. It's great.
They're very nice. They're like diner style. They're like that really thick kind of ceramic. I like it.
I don't drink coffee, so I don't have one yet. Email us, askthecompoundshow@gmail.com. Thanks to everyone in the live chat, as always, for bringing it. Thanks to Bill, thanks to Duncan, all the whole production team, and we'll see you guys next time.
See you, everyone.